On page 52, we're looking at the new revenue recognition standards effective December 2017 for public entities and December 2018 for non-public entities. Now, the previous revenue recognition guidance in US GAAP comprised broad revenue recognition concepts and a lot of revenue requirements which were industry or transaction specific, which sometimes resulted in different accounting for similar transactions across industries. So the way revenue is going to be recognized, let's say in software or in real estate or in financial services or in telecommunications, could be different. Therefore, the new standards, they intend to remove all these inconsistencies and provide a more robust framework for revenue recognition. And we have here a 5-step approach to revenue recognition across industries. So look at this. Revenue from contracts with customers. Entity should recognize revenue to depict the transfer of promised goods or services to customers in an amount that reflects the consideration to which the entity expects to be entitled in exchange for those goods or services. And I know definitions, they're always complicated. So I don't want you to worry out here. Miles has a CPA app for revenue recognition just for you. So I want you to fill in the bubbles that we have there. CPA app and RR for revenue recognition. So guys, this is going to be your mnemonic for the new 5-step approach to revenue recognition. And let's look at all these 5 steps. Step number 1, the C of CPA says identify the contract with the customer. So the C is contract. Step 2, the P of CPA, that is performance obligations. So you need to identify the performance obligations in the contract. So basically all the deliverables. A of CPA, that's amount. So need to determine the transaction price or the amount. Step 4 says allocate price to the performance obligations. So need to allocate the transaction price to performance obligations in the contract. So we said app. So A is allocate, the first P is price, the next P is performance obligations. So allocate the transaction price to the various performance obligations in a contract. It could be a single performance obligation, that means the entire contract is one deliverable, or it could be multiple performance obligations. And the last step, very important, revenue recognition when or as the entity satisfies a performance obligation. So once again, your CPA app for revenue recognition, where the C is contract, P performance obligation, A amount, app is allocate price to performance obligations, and RR, that's revenue recognition as and when the entity satisfies a performance obligation. Over the next few pages, we'll cover all these 5 steps in a lot of detail. I know this sounds really exciting. Moving to page 53, we're looking at step 1, which is identify, put a box around contract with the customer. And right there, CPA app for revenue recognition, circle the C for contract. Basically, a contract is an agreement between 2 or more parties that creates enforceable rights and obligations. Basically, it's a contract when all the parties say, I commit and I commit. So your mnemonic for the criteria for a contract is A, that's all, IC, where IC is I commit. So fill in the bubbles there. A, IC, and IC. So all say I commit and I commit. Where the A stands for highlight approval and commitment of all the parties to the contract. The first I is highlight identification of rights of each party regarding the goods or services to be transferred. The first C is highlight commercial substance that's existent in the contract. The second I is highlight identification of payment terms. And the second C, very important, highlight collectibility is probable. So need to consider the customer's ability and intent to pay the amount of consideration when due. Next, highlight if the above criteria are not met but consideration is received from the customer, which means the contract does not meet the AIC-IC criteria, but consideration or money is received from the customer. Right? For example, dollars received from the customer, but let's say collectibility is not probable, which means that the second C of AIC-IC not met. So guys, we said that for it to be a contract, it needs to meet all of the AIC-IC criteria. So here we have a situation where all of the criteria is not met. For example, collectibility is not probable, but money is received from the customer. The question is, how do you recognize revenue? Highlight, recognize revenue, circle if either of the below is true. So the first one, underline entity has no remaining obligations to transfer goods and services. Highlight and all or substantially all of the consideration is received and is non-refundable. So if this is true, that means the entity has no remaining obligations to transfer any more goods or services and has received all or nearly all of the consideration, which is of course non-refundable, then you recognize revenue, even if the AIC-IC criteria is not met. Or underline contract has been terminated. Highlight and underline consideration received is non-refundable. So if the contract does not meet the AIC-IC criteria, some money is received from the customer, and none of these two conditions that we spoke about is true, then simply highlight recognize as liability until the revenue can be recognized. So that's more like a customer advance which sits on the liability side of the balance sheet. Turn to page 54. We were looking at a couple of examples. The first one is a simple one. Example on identifying the contract and recording transactions. So it says ABC company enters into a contract to transfer goods to XYZ on Jan 1st for $25,000 such that the contract meets all the required criteria. On March 31st of that year, as per the contract terms, XYZ, that's the customer, pays an advance of $20,000. On April 30th, ABC delivers the goods to XYZ, the customer, and has certain manufacturing costs, and XYZ makes the full and final payment on May 30th. So let's first look at the journal entry when ABC receives advance from the customer. So highlight deferred or unearned revenue is recognized by ABC on receipt of the cash advance. So the cash advance from the customer is more like a liability because ABC has not yet delivered, can't recognize revenue yet. And that liability is recognized as underlined deferred or unearned revenue. Thereafter, on April 30th, highlight revenue is recognized by ABC when goods are transferred to XYZ, the customer. Basically, when ABC delivers on the performance obligation. And of course, highlight revenue is credited. It is now that you reverse off, underline the deferred or unearned revenue, which is sitting on the liability side of the balance sheet. So basically, when a cash advance was received, that was recognized as a liability, a deferred unearned revenue. But when the entity delivers and recognizes revenue, that liability is reversed. And of course, the contract was for $25,000. The advance received was only $20,000. The remaining $5,000, that's more like an accounts receivable right now. And as per this example, that remaining 5,000 is paid by XYZ on May 30th. Let's look at the second example. We're talking about the collectibility of the consideration. So here you have Kimco developers who enter into a contract with Hillmart for the sale of a building for $500,000. Kimco's cost of the building is $300,000. Now, Hillmart, the customer, intends to open a retail store in the building. However, new retail stores in the area face high levels of competition and Hillmart has little experience in the retail industry. Hillmart pays a non-refundable deposit, an advance of $50,000 at inception of the contract and enters into a long-term financing arrangement for the balance amount. So the financing arrangement for the balance $450,000 is provided on a non-recourse basis, which means that if Hillmart defaults, Kimco can repossess the building but cannot seek further compensation from Hillmart, even if the collateral does not cover the full value of the amount owed. Though Hillmart obtains control of the building at contract inception, highlight Kimco concludes that collectibility is not probable because Hillmart's ability and intention to pay appeared to be in doubt. And right there, therefore, no contract. So basically, in this case, this arrangement does not meet the AICIC criteria. So the second C of AICIC is collectibility is probable, which is not true in this case. Hillmart's ability and intent appear to be doubtful. So what Hillmart, the customer, is saying that, okay, hey, if I'm not able to pay you the balance, you can take back the goods, you can take back the building, but don't chase me any further for the balance payment. So looking at the solution, what we're saying is regarding the sale value of $500,000, Kimco cannot recognize revenue as the agreement between Kimco and Hillmart does not meet all of the AICIC criteria for a contract. Since of course the second C, collectibility is probable, is not met. Now highlight regarding the non-refundable deposit of $50,000. Kimco cannot recognize revenue as neither the criteria for the contract is met nor any of the below events have occurred. So there are two situations, and if any one of them occurs, Kimco can recognize revenue, but they have not yet occurred. And what has not yet occurred has been underlined below. So let's look at it. So the first situation could be entity has no remaining obligations to transfer goods or services. That's true in this case because Kimco has already given the building to Hillmart. No remaining obligations. But the second part here is all or substantially all of the consideration is received. No, Kimco has received only a small part of the consideration, $50,000 out of $500,000. So all the consideration is not yet received. So can't recognize revenue yet. Even the second condition or the second situation, look at this. Contract has been terminated. No, the contract is not yet terminated. It's still on. Hillmart still has not given up. The second part of the second condition is and consideration received is non-refundable. Well, that's true because the $50,000 that Kimco has received, that's non-refundable. But of course, this condition or this event has not occurred because the contract is still on, not yet been terminated. So basically, Kimco is not in a position to recognize any revenue on this agreement. And the non-refundable deposit of $50,000 received is accounted for as a deposit liability. Now, Kimco is going to recognize revenue on this agreement only when either one of the two conditions is met. So what's pending right now is either Kimco receives all the consideration for Hillmart. So Hillmart pays the entire $500,000 or the remaining $450,000. Or the agreement between Kimco and Hillmart gets terminated. So when either of the two events occur, that is when Kimco is going to be recognizing revenue. Until then, all the money received from Hillmart, starting with this $50,000 received right now, is recognized as a liability. Now that we've spent a lot of time on step 1, the C for contract, AICIC, it's time for us to get on to step number 2 on page 55. So in step 2, need to identify, put a box around performance obligations in the contract. And you can write a mnemonic CPA app for revenue recognition, circle the P. So performance obligation, that's the promise in the contract to transfer a good or service to the customer. The entity should account for each promised good or service as a performance obligation and circle each. So when we say each good or service, we're talking about distinct good or service, which are capable of being distinct, which means that the customer can benefit from the good or service either on its own or together with other resources that are readily available to the customer. And distinct within the context of the contract. That means the promise to transfer the good or service is put a box around separately identifiable from other promises in the contract. And right there, not if. So the goods or services are not separately identifiable if they are highly dependent or interrelated. Or if the entity is providing a significant service of integrating the goods or services to provide a combined output for the customer. or if one or more of the goods or services underlined significantly modifies or customizes other goods or services. So guys, in step 2, when we are identifying the performance obligations in the contract, we need to look out for distinct goods or services, which are number 1, capable of being distinct, and number 2, distinct within the context of the contract, which means separately identifiable. And this helps us understand whether the entire contract is either a single performance obligation or has multiple performance obligations. So we've got an example on this page where we're going to look at, put a box around a single performance obligation in the contract. So it says Buildco, a contractor, enters into a contract to build a shopping mall for a customer. Buildco is responsible for the overall management of the project and identifies various goods or services, including engineering, site clearance, foundation, procurement, construction of the structure, piping and wiring, installation of equipment, and finishing. And you've got to identify the performance obligations in the contract. And we know for goods or services to be distinct, they should be number 1, capable of being distinct, and number 2, distinct within the context of the contract. In this case, highlight goods or services provided by Buildco are capable of being distinct. Right? But, and circle not, highlight distinct within the context of the contract. That means not separately identifiable. Given the fact that Buildco highlight provides a significant service of integrating the goods or services, the inputs into the shopping mall, the combined output for which the customer has contracted. So guys, though there are many goods or services as part of this contract, this is a single performance obligation, as those goods or services which were capable of being distinct, they are not separately identifiable within the context of the contract. Turn to page 56. We'll be looking at another example. And here we have Infosoft, a software developer who enters into a contract with a customer to transfer a software license, perform installation, and provide unspecified software updates and technical support online and telephone for a 5-year period for $500,000. Infosoft sells the license, installation, updates, and support separately. The installation service includes changing the web screen for each type of user, for example, marketing, inventory management, information technology. The installation service is routinely performed by other entities and does not significantly modify the software. And the software remains functional without the updates and the technical support. And your job here is to identify the performance obligations in the contract. So basically, what we have here is put a box around performance obligations and write distinct. So we got 4 distinct performance obligations in this contract. Number 1, it's the software license. Number 2, we're talking about the installation service. Number 3 is software updates. And number 4 is the technical support. And put a bracket around all these. In step 4, which is the app of a CPA app for revenue recognition, we're going to be, right, allocating the $500,000 price to these performance obligations. So in step number 2, your job is to identify performance obligations. In step 4, you allocate price to performance obligations. So basically, in this example, we see that these goods and services are distinct as they meet both the criteria. Number one, of course, they are highlight capable of being distinct. Underline software license is delivered before the other goods and services, and underline remains functional without the updates and the technical support. And criteria 2 highlight these are distinct within the context of the contract, which means separately identifiable. So Infosoft determines that the promise to transfer underline each good and service to the customer is separately identifiable because the software and services are highlight not highly dependent or interrelated. Because Infosoft does not provide a significant service of integrating the software and services into a combined output, which means it is highlight not a combined output. And software and the services do not significantly modify or customize each other. In particular, Infosoft observes that although it integrates the software into the customer system, the installation services do not significantly affect the customer's ability to use and benefit from the software license because the installation services are routine and can be obtained from alternate providers. So the customer can take the software license from Infosoft and get somebody else to do the installation. Also, the software updates do not significantly affect the customer's ability to use and benefit from the software license because the software updates in the contract are not necessary to ensure that the software maintains a high level of utility to the customer during the license period. So the customer can basically continue using the software even without the updates. So basically, guys, what we have here in this example is 4 distinct performance obligations, which are not only capable of being distinct, but also distinct within the context of the contract. That means separately identifiable. Move to page 57, where we've got step 3. Right there, CPA app for revenue recognition and circle A. So step 3 is about determining the transaction price, or put a box around the amount. That's the A of our CPA app for revenue recognition. So we're talking about the amount of consideration which the underlying entity expects to be entitled in exchange for transferring the promised goods or services to the customer. To determine the transaction price or amount, need to consider the effects of number 1, highlight variable consideration. So when we talk about variable consideration, basically the consideration is variable and it could result in a reduction of the amount on the contract or an increase of the amount. Think of price concessions, rebates, or volume discounts on the contract. they could reduce the amount of the transaction price. Think of incentives or performance bonuses on a contract, which could actually increase the amount. Now, variable consideration is a significant change from earlier revenue recognition rules, which did not allow entities to recognize the effect of the variable consideration until the contingency was resolved. However, under the new revenue recognition rules, the entities need to determine and include the variable consideration as part of the amount. And this happens by estimating the variable consideration either using underlying the expected value or the probability weighted amount. Circle or underline the most likely amount of variable consideration, whichever better predicts the amount of the variable consideration. Also need to highlight the existence of a significant financing component, especially if the credit provided to the customer is more than 1 year, where the transaction price needs to be adjusted for the effects of underlying the time value of money. Now, of course, this need not be assessed if customer payment is expected within 1 year of transfer of goods or services. And you can draw an arrow from this sub-bullet down to the example that we have below. So you've got Times Company who delivered capital equipment to LAG on Jan 1st, year 1 for $100,000. As per the contract, LAG needs to pay the amount by December 31st, year 3, which means that here we have a 3-year credit terms without any interest. Now, Times cost of capital is 10%. Need to determine the transaction price for the sale of the equipment. Now, since customer payment is expected beyond 1 year, need to consider the time value of money, based on which highlight the transaction price is $75,131. Now, the balance $24,869, about $25,000, will be recognized as interest income over 3 years. So 75,131, that's the revenue from the contract right now. Then in year 1, Times would recognize interest income of $7,513. In year 2, Times would recognize interest income of $8,265. In year 3, the interest income, that's going to be $9,091. Basically, over the 3 years, Times is going to recognize highlight total interest income of $24,869. So guys, basically the point is the entire $100,000 in the contract is not revenues right now because there is a significant financing component. Let's look at the other couple of sub-bullets. Highlight non-cash consideration, which is to be measured at underlying fair value at contract inception. Highlight consideration payable to the customer. So guys, generally consideration is payable by the customer. But if you are paying consideration to the customer, like a credit, a coupon, or a voucher, that should be accounted for underlined as a reduction of the transaction price. Turn to page 58, where we've got step number 4, which is put a box around allocate, the transaction, put a box around price, to put a box around performance obligations in the contract. So need to allocate price to performance obligations. And that's the app. So right there, CPA app for revenue recognition and Circle app. So for contracts with more than one performance obligation, need to allocate the transaction price to each performance obligation and circle each. And this needs to be done highlight on a relative standalone selling price basis of each distinct good or service in the contract. And let's look at the example on this page. So we are again looking at Infosoft, the software developer who entered into a contract with a customer to transfer number 1, software license, number 2, perform installation, number 3, provide software updates, and number 4, provide technical support. All this for highlight $500,000. Now, Infosoft sells the license, installation, updates, and support separately and has concluded that these are distinct performance obligations. The software license is usually sold for $400,000. Installation service, $50,000. Software updates for $20,000 per year, and they've got 5 years on this contract. Technical support for $50,000 per year. Again, they've got 5 years of technical support on this contract. So basically, highlight the fair value of the contract is $400,000 plus $50,000 plus the $20,000 per year software updates into 5 years plus the $50,000 technical support per year into 5 years. In total, it is highlight $800,000. Now, step number 4, that's about app or allocating price to performance obligations. And we do that on a relative standalone selling price basis. So for the software license, the standalone selling price is $400,000. The fair value of the contract is $800,000. So basically we know that software license, that's like half the value of the contract, which is at $500,000. So of the $500,000, we allocate $250,000, half that number, to software license. Similarly, for installation service, we allocate $31,250 of the $500,000. Software updates, they get an allocation of $62,500, and technical support, that gets an allocation of $156,250. Now, let me give you a quick preview of step number 5, which is about revenue recognition, where we're going to be talking about revenue recognized at a point in time or revenue recognized over time. Now, in this example, the software license or the installation service, these are delivered right now. So put a bracket and write revenue recognized now. However, the software updates and technical support are going to be delivered over the next 5 years. So put a bracket and write revenue recognized over 5 years. So let's say Infosoft gets the entire $500,000 of cash right now. They're going to be recognizing revenue for the software license, which is $250,000, and for the installation service, which is $31,250. $1,250. The remaining amount for the software updates and technical support would be recognized as deferred or unearned revenue. Put a bracket and write liability. And this deferred or unearned revenue would be recognized as revenues over the next 5 years. So right there, 1/5 of the liability, that's going to be the revenue every year over the next 5 years. On page 59, we got step 5, which is put a box around revenue recognition when the entity satisfies a performance obligation. And write a CPA app for revenue recognition and circle the RR for revenue recognition. So for each performance obligation, the entity needs to determine whether it is satisfied, highlight, over time or satisfied at a point in time. Now, for a performance obligation to be considered satisfied over time, any one of the following criteria needs to be met. So put a bracket and write any one. And we've got 3 of the criteria. So the first one, underline, customer simultaneously receives and consumes the benefits provided by the entity's performance as the entity performs. And right there, for example, software updates or technical support. And we saw that in the example on Infosoft that we had on the previous page. The second criteria is that the entity's performance, underline, creates or enhances an asset. For example, a work in process that the customer controls as the asset is created or enhanced. And the third option for the criteria of the performance obligation satisfied over time is that the entity's performance, underline, does not create an asset with an alternative use to the entity, circle, and the entity has, underline, an enforceable right to payment for performance completed to date. And to understand this better, we're going to be looking at an example on the next page. But for now, let's scroll down. So if the performance obligation is highlighted not satisfied over time, consider it to be satisfied at a point in time. And right here, for example, the software license or installation service that we saw for Infosoft, where revenue was recognized right now, right at this point in time. So to highlight, determine the point in time at which to recognize revenue, whether it's now or later, need to consider indicators regarding when the control is transferred. And right here, for example, the software license or installation service that we saw for Infosoft, where revenue was recognized right now, right at this point in time. So to highlight, determine the point in time at which to recognize revenue, whether it's now or later, need to consider indicators regarding when the control is transferred. Let's now look at the example that we have on this page. So we've got O2, which owns golf clubs and allows its customers unlimited use and access of its golf clubs for $18,000 per year. Now, O2's promise to the customer is to provide a service of making the golf clubs available for the customer to use as and when the customer wishes. And the extent to which the customer uses the golf clubs does not affect the amount of the remaining goods and services to which the customer is entitled. So in this case, highlight O2's customers simultaneously receive and consume the benefits of O2's performance, as O2 performs by making the golf clubs available regardless of whether the customers use it or not. Therefore, O2's performance obligation is highlight satisfied over time. So, given the revenue of $18,000 per year per customer, O2 may recognize the revenue at $1,500 per month throughout the year. Turn to page 60, where we've got another example on step 5 revenue recognition with two situations. So we've got Samuel Company, who's developing a multi-unit residential complex. And Samuel enters into a binding sales contract with two customers, first with Xavier and the second with Yulia, for two different specified units that are under construction. Each unit has a similar floor plan and is of similar size, but other attributes of the units are different. For example, the location of the unit within the complex. Now, you've got to determine for each of the two contracts whether Samuel satisfies the performance obligation over time or at a point of time. So the first one, the contract with Xavier, where Samuel does not have an enforceable right to payment for the performance completed to date. So Xavier pays a deposit upon entering into the contract, and the deposit is refundable only if Samuel, the developer, fails to complete construction of the unit as per the contract. The remainder of the contract price is payable by Xavier on completion of the contract, when Xavier actually obtains the physical possession of the unit. But if Xavier defaults on the contract before completion of the unit, Samuel only has the right to retain the deposit which Xavier has paid initially. Highlight: Samuel determines that it does not have an enforceable right to payment for performance completed to date, which means that Samuel is not getting the payment until construction of the unit is complete. And until then, Samuel only has the right to the deposit which has been paid by Xavier. Therefore, Samuel accounts for the sale of the unit as a performance obligation, highlight satisfied at a point in time. At a point in time later, which is after the construction of the unit is complete. But we have a different situation with Yulia, where as per the contract, Samuel has an enforceable right to payment for performance completed to date. So look at this. Yulia pays a non-refundable deposit upon entering into the contract and will make progress payments during the construction of the unit. The contract has substantive terms that preclude Samuel from being able to direct the unit to another customer. So can't sell the unit which has been given to Yulia to another customer. In addition, Yulia does not have the right to terminate the contract unless Samuel fails to perform as promised. If Yulia defaults on its obligations by failing to make the promised progress payments as and when they're due, Samuel would have a right to all of the consideration promised in the contract if it completes the construction of the unit. So basically, Samuel can go out and sue Yulia to recover the remaining amount. The courts have previously upheld similar rights that entitle developers to require the customer to perform subject to the developer meeting its obligations under the contract. Now, in this case, Samuel's performance obligation is highlighted satisfied over time, as the contract satisfies the condition, which is entity's performance does not create an asset with an alternative use to the entity, and the entity has an enforceable right to payment for the performance completed to date. So basically, this is one of the three criteria that we had seen on the previous page regarding a performance obligation being satisfied over time. And we said any one of the criteria needs to be met. And in this case, highlight the asset or unit created by Samuel's performance does not have an alternative use to Samuel, because the contract precludes Samuel from transferring that unit to any other customer. And highlight Samuel has a right to payment for performance completed to date. And therefore, this performance obligation is considered satisfied over time. So turn a few pages till you get to page 61, where we're looking at put a box around costs. So first, let's talk about underline incremental costs of circle obtaining a contract. So these are costs that the entity would not have incurred if the contract had not been obtained. These incremental costs are accounted for as asset if they are underlined expected to be recovered. Unless the recovery or amortization underline period is 1 year or less. Now that we've looked at incremental costs of obtaining a contract, let's look at underline costs incurred in circle fulfilling the contract. And these costs are treated as asset only if all three criteria are met, and put a bracket around these three criteria. So the first criteria is underline relate directly to a contract. Second one, underline generates or enhances resources of the entity that will be used in satisfying performance obligations in the future. And these costs are underlined expected to be recovered. Now, to understand these better, let's look at a couple of examples. So the example that we have on this page is about incremental costs of obtaining a contract. So IBM, that's a consultant, wins a competitive bid to provide IT services to Clark for a term of 4 years, which IBM anticipates to be renewed for 2 subsequent 1-year periods. So basically 4 years initial term plus expected renewal for another 2 years, total of 6 years that we're talking about. IBM incurred the following costs to obtain the contract. First one, external legal fees for due diligence, $25,000. Travel costs to deliver the proposal, $20,000. Commissions to sales employees, $15,000. So that makes it total costs of obtaining the contract, the total incremental costs, $60,000. Now, determine the cost to be capitalized, that's recognized as an asset. Highlight commissions to sales employees of $15,000 is recognized as an asset as IBM expects to recover those costs through future fees for consulting services. And these would be amortized over the 6-year period. However, the external legal fees for due diligence, $25,000, and the travel costs, $20,000, are expensed as these would have been incurred even if IBM did not get the contract. So basically, I want you to put a cross around both these expenses, while I want you to put a circle around the commissions to sales employees of $15,000 and write asset. So guys, if you're understanding, IBM would naturally not have paid the commission to the sales employees had IBM not obtained the contract. But external legal fees and travel costs, they were incurred irrespective of IBM getting or not getting the contract. And that's the reason why these commissions which IBM pays to its sales employees is capitalized as an asset and amortized over 6 years. Let's flip back to page 52, where we have all the 5 steps in one page. So, you know my mnemonic, CPA app for revenue recognition, where step number 1 was identify the contract. Step number 2, identify performance obligations. Step number 3, determine the amount. Step number 4 was about allocating the transaction price to performance obligations, the app. And step number 5 was revenue recognition when or as the entity satisfies a performance obligation, whether over time or at a point in time. Now that we've looked at the revenue recognition part, let's spend some time talking about costs and contract asset or liability. So turn a few pages till you get to page 61, where we're looking at put a box around costs. So first, let's talk about underline incremental costs of circle obtaining a contract. So these are costs that the entity would not have incurred if the contract had not been obtained. These incremental costs are accounted for as asset if they are underlined expected to be recovered. Unless the recovery or amortization underline period is 1 year or less. Now that we've looked at incremental costs of obtaining a contract, let's look at underline costs incurred in circle fulfilling the contract. And these costs are treated as asset only if all 3 criteria are met, and put a bracket around these 3 criteria. So the first criteria is underline relate directly to a contract. Second one, underline generates or enhances resources of the entity that will be used in satisfying performance obligations in the future. And these costs are underlined expected to be recovered. Now, to understand these better, let's look at a couple of examples. So the example that we have on this page is about incremental costs of obtaining a contract. So IBM, that's a consultant, wins a competitive bid to provide IT services to Clark for a term of 4 years, which IBM anticipates to be renewed for 2 subsequent 1-year periods. So basically 4 years initial term plus expected renewal for another 2 years, total of 6 years that we're talking about. IBM incurred the following costs to obtain the contract. First one, external legal fees for due diligence, $25,000. Travel costs to deliver the proposal, $20,000. Commissions to sales employees, $15,000. So that makes it total costs of obtaining the contract, the total incremental costs, $60,000. Now, determine the cost to be capitalized, that's recognized as an asset. Highlight commissions to sales employees of $15,000 is recognized as an asset as IBM expects to recover those costs through future fees for consulting services. And these would be amortized over the 6-year period. However, the external legal fees for due diligence, $25,000, and the travel cost, $20,000, are expensed as these would have been incurred even if IBM did not get the contract. So basically, I want you to put a cross around both these expenses, while I want you to put a circle around the commissions to sales employees of $15,000 and write asset. So guys, if you're understanding, IBM would naturally not have paid the commission to the sales employees had IBM not obtained the contract. But external legal fees and travel costs, they were incurred irrespective of IBM getting or not getting the contract. And that's the reason why these commissions which IBM pays to its sales employees is capitalized as an asset and amortized over 6 years. Turn to page 62, where we have an example on costs incurred in fulfilling the contract. So it says, further to obtaining the contract, IBM designs and builds a technology platform for IBM's internal use that interfaces with Clark's systems. That platform is not transferred to Clark, but IBM will use it to deliver services to Clark. Now, initial costs incurred by IBM to set up that technology platform are design services of $50,000, which of course enhances IBM's resources and expected to be recovered. Migration or testing data center, $60,000, which again enhances IBM's resources expected to be recovered. Hardware of $70,000, which is actually PP&E or property, plant and equipment. Software, $80,000, which are costs incurred in the development stage of the software. So the total costs incurred by IBM in building the technology platform is $260,000. Additionally, IBM assigns one employee who receives an annual salary of $75,000 and who is primarily responsible for providing the services to Clark. But that salary which is paid to that employee does not generate or enhance resources of IBM. The employee spends 80% of her time on the clerk engagement and 20% of her time supporting other customers. And your job here is to determine the cost to be capitalized, that's recognized as an asset. Highlight the cost of design $50,000 and migration or testing of the data center for $60,000 are capitalized as an asset as they meet all required criteria. So all the three criteria: number one, relate directly to the contract; number two, generate or enhance resources of the entity; and number three, are expected to be recovered. Highlight hardware costs $70,000 are capitalized as PP&E or property, plant and equipment. Highlight software costs of $80,000 are capitalized as internal use software costs, since these have been incurred in highlight development stage and these would be amortized. So put a circle around the entire $260,000 and all of it is capitalized as asset. However, when we talk about the employee salary, though that salary was incurred as part of providing the service to clerk, IBM concludes that these costs do not generate or enhance the resources of the entity. Therefore, the salary is recognized as payroll expense when incurred. So I want you to cross out the $75,000 which is not capitalized but expensed during the year. Move to page 63, where we're talking about recognition of a contract asset or a contract liability. So put a box around contract asset, which is highlight a right to consideration in exchange for the goods or services transferred to a customer. Highlight when that right is conditioned on something other than the passage of time. For example, the entity's future performance. Note that if the right to consideration for the entity is conditioned on a passage of time, that is recognized as an accounts receivable. But if the right to consideration is conditioned on something other than the passage of time, that's when it becomes a contract asset. So let's look at the example that we have here. So on Jan 1st, year 1, Adam Company enters into a contract with XYZ Co. to transfer equipment A and equipment B for a total price of $8,000. An agreement that consideration will be due only after both the equipment are transferred to XYZ. Equipment A is delivered on March 31st, while equipment B is delivered on June 30th. The standalone prices of equipment A and B are $3,500 and $4,500 respectively. So on March 31st, when Adam transfers equipment A, the consideration is not yet due, as only equipment A is transferred and the consideration would be due only when both the equipment are transferred. So Adam now recognizes a contract asset and not a receivable from XYZ. So contract asset is debited $3,500 and revenue is credited $3,500. On June 30th, when equipment B is transferred by Adam, that's when Adam recognizes a receivable of $8,000 from XYZ. The contract asset of $3,500 is reversed off and additional revenue of $4,500 is recognized for equipment B. Look at the example. On Jan 1st, year 1, Luke enters into a cancelable contract to transfer a product to Claire for $9,000. Claire pays advance consideration on March 1st as per the terms of the contract. Luke transfers the product on May 1st. So guys, when cash is received by Luke in advance of performance on March 1st, that's recognized as deferred or unearned revenue, a contract liability. Only when Luke satisfies the performance on May 1st that contract liability, that deferred or unearned revenue, is reversed off and revenue is recognized. Now, the revenue recognition standards also have a lot of, put a box around, disclosure requirements. Highlight qualitative and quantitative information is required about, highlight the contracts with customers, which includes revenue and impairments recognized, disaggregation of revenue, and information about contract balances and performance obligations. Highlight significant judgments and changes in judgments. Need to determine the timing of satisfaction of performance obligations, whether over time or at a point in time. Highlight assets recognized from the cost to obtain or fulfill a contract. Turn to page 64. So until now on revenue recognition, we've covered the 5 steps. Then we spoke about costs or contract asset or liability or required disclosures. Now in this portion, we're going to talk about certain customers' rights and obligations. And we start with, put a box around, warranties. Now highlight if a customer has the option to purchase a warranty separately. Highlight account for the warranty as a separate performance obligation, because highlight warranty becomes a distinct service. Right? Else the warranty is underlined accounted for by creating an allowance for warranty expense. Circle however and highlight if the warranty provides a service in addition to the assurance that the product complies with agreed upon specifications, then it needs to be accounted for as a performance obligation. So guys, basically our question is the warranty a separate performance obligation or not? So if the warranty is sold separately or the customer has an option to purchase the warranty separately, it's a separate obligation. Also, if the warranty provides a service in addition to an assurance on the product, even then the warranty is a separate performance obligation. Few factors that might be considered to determine this include whether the warranty is underlined required by law. So if the entity is required by law to provide a warranty, then the warranty generally is underlined not a performance obligation. You might want to look at the length of the warranty coverage period. Highlight longer the coverage period, the more likely it is that the warranty is a performance obligation. You might want to look at the nature of the tasks that the entity promises to perform. Now, if the entity underlined needs to perform specified tasks to provide the assurance that the product complies with agreed upon specifications, for example, a return shipping service provided by the entity for a defective product, then those tasks are likely underlined not a performance obligation. Move to page 65. If we're talking about sale where the customer has, put a box around right of return. Now, to account for, highlight revenue for the transferred products. Note, underline revenue would not be recognized for the products expected to be returned. Recognize, highlight refund liability based on the expectations about the amounts of refunds. So this is what, right, the seller is to pay back to the customer on the return. Also recognize, highlight an asset, which is actually the cost of the goods that the seller would receive back from the customer when the customer returns them. So right there, seller to receive back the goods. Let's look at the example that we have here. Retro company enters into 100 contracts with customers, where each contract includes the sale of one product for $1,000. So the total consideration is $1,000 into 100 units, that's $100,000. Cash is received when control of a product transfers. And Retro's customary business practice is to allow a customer to return any unused product within 30 days to receive a full refund. Retro's cost of each product is $700. Since the contract allows a customer to return the products, the consideration received from the customer is variable. And to estimate the variable consideration to which Retro will be entitled, Retro decides to use the expected value method. And using that method, Retro estimates that 96 products will not be returned. So looking at the solution that we have here, Retro transfers control of 100 products, but recognizes revenue, highlight, for $96,000. So that's the 96 units, highlight, not expected to be returned. The remaining 4 units is recognized as, highlight, a refund liability for $4,000. So these are the units which are, highlight, expected to be returned. Retro also recognizes, highlight, an asset for $2,800. So that's $700 into 4 units. The cost of the 4 units which Retro expects to be returned back by the customer. So highlight right to recover products on refund. So in effect, Retro is recognizing revenue for 96,000 units, that's $96,000, and cost of goods sold expensed on the income statement is also for those 96 units. So $700 into 96 units, that is $67,200. On page 66, put a box around customer acceptance, which, right, indicates that customer has obtained control. So customer acceptance could be an important consideration before revenue recognition, right? Except, highlight, if an entity can objectively determine that control of a good or service has been transferred to the customer. And highlight, the customer acceptance is only a formality. On page 67, put a box around customer options for, underline, additional goods or services. So if the customer has options to acquire additional goods or services for free or at a discount, like sales incentives, customer award credits or points, contract renewal options, or other discounts on future goods or services, these could be put a box around a performance obligation in the contract, highlight only if this option provides a material right to the customer. Underline that the customer would not receive without entering into that contract. And of course, if this customer option is a separate performance obligation, need to, as per step 4, highlight allocate price to performance obligations. So that was the app of a CPA app for revenue recognition. On page 68, put a box around non-refundable upfront fees. So if the contract has a non-refundable upfront fees to be paid by the customer, the entity should highlight assess whether the fee relates to the transfer of a promised good or service. Put a bracket around the next two sub-bullets, write if yes, and highlight upfront fee is an advance payment for the future goods or services, and therefore would be highlight recognized as revenue when those future goods or services are provided. Right? If not, right, recognize revenue now. On page 69, we're talking about customers' unexercised rights, where right customer prepays but does not come back to claim the goods or services. And these unexercised rights by the customers are referred to as right breakage. So few lines below highlight if an entity expects to be entitled to a breakage amount in a contract liability, the entity should highlight recognize the expected breakage amount as revenue. Think about it. The customer has prepaid, but the entity expects that the customer is not going to come back to claim the good or service. And it makes sense for the entity to recognize revenue in proportion to the pattern of rights exercised by the customer. Right? Else, wait until underline customer exercising its remaining rights becomes remote. On page 70, we're looking at repurchase agreements, which is a contract in which an highlight entity sells an asset, circle, and also underline promises or has underline option highlight to repurchase the asset. Now the repurchase agreements, they may need to be recorded as right a lease, a financing arrangement, or a sale with right to return. And to understand this better, let's look at the examples on the next page. On page 71, we have Regain Company, which is a real estate developer and has two residential buildings which were built to sell, located next to each other. On Jan 1st, year 1, Regain sells these two buildings to Kathy and Pamela for $500,000 and $600,000 respectively. Based on the below additional facts and provisions on the contracts, determine how should Regain account for the transactions. So the first one, highlight sale of asset to Kathy for $500,000 with a call option. So this contract includes a call option highlight that gives Regain the right to repurchase the asset for $550,000 on or before December 31st. However, Regain does not exercise the option which lapses on December 31st. So control of the asset does not transfer to Kathy until December 31st because Regain has a right to repurchase the asset. Consequently, Regain accounts for the transaction as highlight a financing arrangement because underlying the exercise price is more than the original selling price. To make it very simple, think of this as a financing arrangement where Regain takes a loan of $500,000 from Kathy and Regain gives the residential building to Kathy as a collateral. And what Regain says is, by the end of the year, I'm going to give you $550,000, which is the 500 principal plus another 50,000 interest. And when I give you the 550, I'm going to take back the residential building that I've given to you as collateral. But what we see here is Regain does not exercise the option which lapses on December 31st. Only after the option lapses, Regain recognizes revenue. And basically, Regain recognizes revenue for $550,000, of which $500,000 Regain has received as cash from Kathy, and the $50,000 is the interest component because this contract was structured as a financing arrangement. Look at the next case. Highlight sale of asset to Pamela for $600,000 with a put option. Highlight that obliges Regain to repurchase the asset at Pamela's request. So here Pamela has a right to give back the asset to Regain for $580,000 on or before December 31st. And note that the market value of the asset is expected to be $550 on December 31st. So naturally, there is a high incentive for Pamela to give the asset back to Regain because Pamela is going to get $580,000, which is more than the $550 market value. So underline, Pamela has a significant economic incentive to exercise the put option. So to keep it very simple, think of this transaction or the contract as a lease arrangement where Pamela pays $600 to Regain at the beginning of the year and at the end of the year takes back $580. So the $20 shortfall is like the lease rental for the year that Pamela pays to Regain. Therefore, Regain accounts for this contract as highlight a lease because underlying the exercise price of $580 is less than the original selling price of $600. The $20 differential, think of it as lease rental. Now that we've looked at these examples, let's get back to page 70 and read a little bit more about repurchase agreements. So we've already said that repurchase agreements could be in the form of a lease, and we've seen that in case of Pamela. It could be a financing arrangement. We've seen that in case of Kathy, or it could be a sale with a right to return. On the second bullet, put a box around forward or call option. which is right, the seller's obligation or an option. So if the contract has a forward or a call option, highlight customer does not obtain control of the asset, even though customer may have physical possession of the asset. Think about it. The seller is obliged, or the seller has an option of taking back the asset from the customer. So basically, the customer does not control the asset. Now, such contracts could be accounted for as either underlying lease or underlying financing arrangement. So lease is when the original selling price is greater than the repurchase price. And it would appear as if, right, the buyer pays for the use of the asset. Such contracts need to be accounted for as a financing arrangement if the repurchase price is greater than or equal to the original selling price. And we saw that in the case of a Regain selling the asset for $500,000 to Kathy and then having an option of buying it back for 550. So the repurchase price of 550 was greater than the original selling price of 500. Hence, it was like a financing arrangement where, right, seller pays interest on loan. The $50,000 was like the interest on loan, while asset is the collateral. On the third bullet, put a box around put option. And this one is right, customer's option. So basically, if the entity has highlight an obligation to repurchase the asset at the customer's request, then we need to compare the repurchase price with the original selling price. Highlight if the repurchase price is less than the original selling price, may need to account for as underline a lease or underline a sale with a right of return. And on lease, draw an arrow and write customer pays for use of asset. And that is exactly what we saw in case of Regain selling the asset to Pamela, where Pamela had purchased for $600,000 the original selling price and had an option of giving it back to Regain for 580, such that the repurchase price of 580 was less than the original selling price of 600. And it appeared as if Pamela, the customer, was paying $20,000 for using the asset for the year, like a lease arrangement. However, highlight if the repurchase price is greater than or equal to the original selling price, account for the contract as underline a financing arrangement or underline a sale with right of return. On financing arrangement, draw an arrow and write seller pays interest on loan while the asset is the collateral. So guys, as we discussed, repurchase agreements may need to be accounted for as a lease or a financing arrangement or a sale with right to return. Starting page 72, we're looking at a few specific arrangements, and this is the last leg on a portion on revenue recognition. So we have principal versus agent consideration on this page. Now, when another party is involved in providing goods or services to a customer, the entity is required to determine whether it's the principal or the agent. Now, if entity is put a box around principal, recognize, highlight gross amount of consideration as revenue. Basically, principal is when the entity highlight controls the specified good or service before the same is transferred to a customer. However, an entity does not, circle not, underline necessarily control a specified good, underline if the entity obtains legal title to that good only momentarily before the legal title is transferred to a customer. Now, to determine that an entity is a principal, look out for few indicators like whether entity is highlight primarily responsible or the entity highlight has inventory risk or that the entity highlight has discretion in establishing the price for the good or service. Underline, however, even an agent can have discretion. Now, if the entity is put a box around an agent, recognize, highlight the fee or commission as revenue. Now, agent is when the performance obligation is to highlight arrange for the provision of goods or services by another party. The agent highlight does not control the specified good or service. Move to page 73, where we're looking at a couple of examples. The first one is where GE enters into a contract with ABC for equipment with unique specifications. GE and ABC develop the specifications for the equipment. Now, GE contracts with Xing, the Chinese vendor, to manufacture the equipment as per these specifications. GE also arranges to have Xing deliver the equipment directly to ABC when completed. Upon delivery of the equipment to ABC, GE is to pay Xing $600,000 as agreed to by GE and Xing for manufacturing the equipment. However, GE and ABC agree to a $725,000 selling price, which GE would invoice to ABC upon delivery of the equipment with a 60-day payment terms. Therefore, GE's profit in this deal is $125,000. The contract between GE and ABC requires ABC to seek remedies for defects in the equipment from Xing under Xing's warranty. However, GE is responsible for any corrections to the equipment required resulting from errors in specifications. Now, you need to determine whether GE is acting as a principal or an agent in its contract with ABC. And the answer is that highlight GE is acting as a principal in the contract as it provides the significant integration of design and manufacturing necessary to produce the specialized equipment and therefore highlight controls the specialized equipment before it's transferred to ABC. Note that GE directs the use of Xing's manufacturing service as an input in creating the combined output, that is the specialized equipment. Also, note the below indicators which indicate that GE is acting as a principal. Highlight GE is primarily responsible. Highlight GE has inventory risk as it's responsible for any corrections required resulting from errors in specifications. Highlight GE has discretion in establishing the selling price. Now, we all know Amazon, we know Alibaba, and on the next example, we have Ambaba, who operates an e-commerce website where customers purchase goods from a range of suppliers. The goods are directly delivered by the suppliers to the customers, where Ambaba gets commission of 15% of the sales price. Ambaba facilitates the payment between the supplier and customer at price levels set by the supplier. Once payment is made, only then the orders are processed and are non-refundable. Ambaba has no further obligation to the customer after arranging for the products to be provided to the customer. And your job is to determine whether Ambaba is acting as a principal or agent. And the answer is highlight Ambaba is acting as an agent, as it highlight does not control the specified goods provided by the suppliers before the goods are transferred to the customers. Further, looking at the indicators, it's the suppliers who are primarily responsible. It's the suppliers who have inventory risk, and it's the suppliers who have discretion in establishing the selling price. And therefore, Ambaba is only an agent in this example. On page 74, we're looking at consignment arrangements, which is when an entity delivers a product to a dealer or a distributor for sale to end customers, and the dealer or distributor does not obtain control of the product. Highlight revenue is recognized when the dealer or distributor highlight sells the product to the end customer, circle, or highlight obtains control of the product, let's say after a specified period of time expires. Now, indicators that an arrangement is a consignment arrangement include that underlying entity controls the product and not the dealer or distributor. Underlying entity is able to require the return of the product from the dealer or distributor. Underlying dealer or the distributor does not have an unconditional obligation to pay. And you can put a bracket around these indicators and write consignment arrangement, which means that it's not revenue yet. Look at the example that we have here. So, Honey Company is a large manufacturer of HVACs. Honey has a network of dealers to whom Honey delivers the HVACs and who sell these HVACs to the end customers. Honey's terms with the dealers. Number one, Honey will continue to own legal title of HVACs until these are transferred to the end customer. Number two, Honey can require dealers to return the HVACs or even transfer to another dealer. Dealers are supposed to pay for the HVACs when legal title is transferred to the end customer. And therefore, it's pretty clear that Honey should account for the delivery of these HVACs to the dealers as a consignment arrangement, not a revenue yet. Because Honey continues to control the HVACs until they are sold to the end customer. Because Honey is able to require the return or transfer of the HVACs. And of course, the dealer does not have an unconditional obligation to pay until the HVACs are sold to the end customer. On page 75, we're looking at bill and hold arrangements. So that's a contract in which an entity bills a customer for a product, circle but, highlight holds physical possession of the product until it is transferred to the customer at a future point in time. Highlight revenues should be recognized only when the customer obtains control of the product. And for the customer to have obtained control, all of the following criteria must be met. The first one, underline, there should be a substantive reason for the bill and hold arrangement. For example, the customer has requested the arrangement. Underline, product must be identified separately as belonging to the customer. Underline, product currently must be ready for physical transfer to the customer. And underline, entity cannot use the product or direct it to another customer. Put a bracket and write control transfers if all are met. Let's look at the example that we have here. So Bill Howard Corp enters into a contract with Gray Company on Jan 1st, year 1 for the sale of a machine and spare parts. The manufacturing lead time for the machine and spare parts is 1 year. On December 31st, year 1, Gray pays for the machine and spare parts but only takes physical possession of the machine. Although Gray inspects and accepts the spare parts, Gray requests that the spare parts be stored at Bill Howard's warehouse because of its close proximity to Gray's factory. Bill Howard stores the spare parts in a separate section of its warehouse, and the parts are ready for immediate shipment at Gray's request. Bill Howard stores the spare parts for 2 years and does not have the ability to use the spare parts or direct them to another customer. Determine the performance obligations and the timing of revenue recognition. So the transaction price needs to be allocated to 3 performance obligations. Of course, the first one is the promise to transfer the machine, and revenue is recognized on December 31st, year 1, when control transfers to Gray. The second performance obligation is the promise to transfer spare parts, where revenue again is recognized on December 31st, year 1, when control transfers to Gray, even though Gray does not obtain physical possession, because it meets the requirements of bill and hold arrangement. Let's quickly review the criteria for bill and hold arrangement in the context of this example. So number 1, it was Gray, the customer, who requested the arrangement. Number 2, the spare parts were separately identified as belonging to Gray. Number 3, the spare parts were ready for physical transfer to Gray. And number 4, Bill Howard, the entity, did not have the ability to use the spare parts or direct them to another customer. And that is where the promise to transfer spare parts was recognized as revenue on 31st December itself. The third performance obligation in this contract is highlight custodial services related to the spare parts, where highlight revenue is recognized over time over the 2 years that Bill Howard agrees to hold on to the spare parts on behalf of Gray. Starting page 76, we're looking at licensing arrangements for intellectual property. On the second bullet there, highlight symbolic intellectual property, where the license grants the customer highlight right to access, and revenue is recognized highlight over time. Next is highlight functional intellectual property, which has significant standalone functionality. For example, the ability to process a transaction, perform a function or task, or be played or aired. Now, in a functional intellectual property, the license grants the customer highlight right to use, and revenue is recognized highlight at the point in time at which the license is granted. And to understand revenue recognition for intellectual property, I'm going to give you a mnemonic, which is that Saturdays are fun. So write SAT for Saturday, right? Symbolic equals access slash overtime. And right, fun, which is functional, right to use at a point in time, and it's right now. So SAT is symbolic, access, over time. FUN is functional, that's a functional intellectual property, right to use, and revenue recognized at a point in time, right now. Move to page 77, where we have a flow chart to understand licensing arrangements for intellectual property. The first question is that does the intellectual property have highlight significant standalone functionality? If it's circle no, then it is highlight a symbolic intellectual property where license equals highlight right to access, and highlight revenue is recognized over time. And right there, SAT for Saturdays, symbolic equals access over time. However, if the intellectual property does have significant standalone functionality, circle yes, then it is right a functional intellectual property. And highlight functional intellectual property, that's a license which is highlight right to use, and highlight recognize revenue at a point in time, maybe right now. So we said Saturdays are fun. So write FUN, that's functional use now. However, note that for functional intellectual property, need to check out for a couple of exception criteria. So right there, check exception criteria number 1. And that criteria is that is the functionality of the functional intellectual property expected to substantially change as a result of the entity's activities other than the transfer of goods or services. If yes, then write check exception criteria number 2. And the second exception criteria is whether the customer is contractually or practically required to use the updated intellectual property. And if the answer is yes, right, exception if both criteria are met. In such a case, the functional intellectual property is underline a right to access and underline revenue recognized over time. So the general rule for functional intellectual property is FUN, which is the functional intellectual property is a right to use, revenue recognized now, that's at a point in time. However, there could be an exception kicking in for functional intellectual property if both these exception criteria are met. Turn to page 78, where we've got a couple of examples on functional intellectual property. So the first one, Infosoft, a software developer, enters into a contract with the customer to transfer a software license, perform installation, and provide unspecified software updates and technical support for a 5-year period for $500,000. Infosoft sells the license, installation, updates, and support separately and has concluded that these are 4 distinct performance obligations. The question is the put a box around software license right to use or access the software? Now, the software license is highlight a functional intellectual property because the software has significant standalone functionality. Now, because Infosoft's promise to provide software updates represents an additional promised service in the contract, highlight exception criteria 1 is not met. Also, the customer has the right to install or not install software updates when they are provided, such that highlight exception criteria 2 is also not met. Therefore, our mnemonic, right, FUN, FUN holds true, where the functional intellectual property provides the customer with highlight right to use the software as it exists now. That means at highlight point in time. The next example is about Melody Records, a music record label who licenses to a customer a 1975 recording of a classical symphony by a noted orchestra. The customer, a consumer products company, has the right to use the recorded symphony in all commercials, including television, radio, and online advertisements for 2 years in the US starting on Jan 1st, year 1. In exchange for providing the license, Melody receives fixed consideration of $10,000 per month. The contract does not include any other goods or services to be provided by Melody, and the contract is non-cancelable. Is the license a right to use or access? So now the classical symphony recording is highlight a functional intellectual property with a significant standalone functionality, and the contract does not require, and the customer does not even expect, that Melody will undertake activities to change the licensed recording. Therefore, highlight exception criteria number 1 is not met. Therefore, Melody concludes that, right, FUN, fun, holds true. That means this functional intellectual property provides the customer with highlight right to use its intellectual property at highlight a point in time the license is granted. That's right now. So once again, because the classical symphony recording is a functional intellectual property which grants the customer the right to use, the revenue is to be recognized at the point in time the license is granted. That means right now. So Melody is going to recognize the entire revenue. That's $10,000 per month into 24 months. That's $240,000 right now. The only consideration here is that since the time period is over 2 years and it's greater than 1 year, Melody needs to adjust the $240,000 transaction price for the effects of time value of money because of a significant financing component. Move to page 79, where we're looking at a couple of examples on symbolic intellectual property. So, Forever Company enters into a contract with a customer and promises to grant, put a box around, a franchise license that provides the customer with the right to use Forever's trade name and sell Forever's products for 10 years. In exchange for granting the license, Forever receives a fixed fee of $700,000 as well as a sales-based royalty of 5% of the customer's monthly sales for the term of the license. Is the franchise license right to use or access? Now, Forever assesses that its trade name and logo have limited standalone functionality, and the utility of the products developed by Forever are derived largely from the product's association with the franchise brand. Substantially all of the utility inherent in the trade name, logo, and product rights granted under the license stems from Forever's past and ongoing activities of establishing, building, and maintaining the franchise brand. The utility of the license is its association with the franchise brand and the related demand for its products. Therefore, Forever concludes that this is highlight a symbolic intellectual property. And right there, SAT, so that's SAT for Saturdays which are fun. The S of SAT is symbolic intellectual property. A is highlight the right to access, and T is where the performance obligation is highlight satisfied over time, and that is where highlight the fixed $700,000 fees is recognized over time, underline over 10 years, and highlight the sales based royalty is underline recognize revenue as and when sales occur. Let's look at the next example on Catala Creative Cohort, a creator of comic strips who licenses the use of the images and names of its comic strip characters in two of its comic strips to a customer for a 3-year term. There are main characters involved in each of the comic strips. However, newly created characters appear and disappear regularly, and the images of the characters evolve over time. The customer and operator of cruise ships can use Catala's characters in various ways, such as in shows or parades within reasonable guidelines. In exchange for granting the license, Catala receives a fixed payment of $250,000 in each year of the 3-year term. Now, Catala assesses that the license has no standalone functionality. That means the names and the images cannot process a transaction, perform a function or task, or be played or aired separate from significant additional production that would, for example, use the images to create a movie or a show. And the utility of those names and images is derived from Catala's past and ongoing activities, such as producing the weekly comic strip that includes the characters. Therefore, Catala concludes that these comic strips highlight symbolic intellectual property. And right there, S-A-T. So S is symbolic intellectual property. A is highlight right to access. And T is where the performance obligation to transfer the license is highlight satisfied over time. And that is where highlight the annual $250,000 fees is recognized over time. That means underline $250,000 per year over the 3-year term. So guys, as we wrap up on license arrangements, remember, Saturdays are fun.